if you'll look at what gold did, it moved up in layers and sometimes would be stuck in a horizontal zone for a handful of months. Go back to April of 24, for example. We said in March of 24, expect the beginning of the bull market again. In other words, it's been asleep for 3 years. And it sure enough, it engaged, but it still had these layered, time-consuming zones of nothing, where we just simply hold and absorb the selling and finally can go up again. Well, right now we're in the second week of a pullback, period. So in fact, it's not even a full 2 weeks because, anyway, the number of days is a handful. And I suspect this will be brief. It won't be multi-month. I don't think we're going to correct like everybody seems to think. We're going down to 2,800. I think what people are doing, our price chart is primarily, is when they project, it's all over for now, we got to go back down to here. Every time they do that, what they're doing is they're finding the prior shelf of highs that was broken through, and then you get a surge, and they seem to insist that you must go back to that prior high.
While gold has surged approximately 28% year-to-date, reaching record highs near $3,500 per ounce, silver has experienced a more modest increase of about 15%, currently trading around $33 per ounce. This disparity has widened the gold-to-silver price ratio to over 100 to 1, significantly above the historical average of 40-60 to 1, suggesting that silver may be undervalued relative to gold. Analysts indicate that silver's recent pullback may be concluding, setting the stage for a potential rally. Technical patterns, such as the inverted head and shoulders formation, support this outlook, with projections aiming for resistance levels around $34 to $35 per ounce. Silver's dual role as both a precious and industrial metal positions it uniquely in the market. Approximately 60% of silver demand stems from industrial applications, notably in solar panels, electric vehicles, and electronics. This demand is expected to remain robust, driven by global investments in renewable energy and technology sectors. However, silver's supply faces challenges. Production growth is limited, with mining concentrated in geopolitically sensitive regions like Russia and Kazakhstan, where expansion is constrained. The Silver Institute forecasts a significant supply deficit, with demand outpacing supply by approximately 200 million ounces in 2024, a trend anticipated to continue. Given these factors, silver prices are projected to rise. Analysts forecast prices reaching $36.60 to $39.30 per ounce in the near term, with potential to exceed $50 by year-end if industrial demand remains strong and supply constraints persist. Investors should consider silver's volatility and the broader economic context. While gold continues to benefit from central bank purchases and safe haven demand, silver's industrial ties may offer higher upside potential, albeit with increased risk.
To test the price high, and gold hasn't done that. Instead, it's pulled back but never gone back to the prior high. And right now, the assumption is, we're going to have to drop $500 from the high to get down to 2,800, and it's going to take a long time, etc., etc. And this derails people emotionally and a lot of them get out of their positions. And we made a point of that in the last weekend report. We showed, I think it was 2010-11 phase in the gold bull market then, where we were in the acceleration phase. And we circled all the times where you had these scary downside breaks and or congestion zones. And we posed the question at each of the breaks. We said, you got out, but did you get back in? Because usually, boom, if you weren't really precise, if you got out, you didn't get back in, unless it made a new high again, in which case you missed a chunk. You get the point. I think that's where we are. Silver's the wild child. When gold had a mild little pullback during that stock market break in the first week of April, silver had a huge break. It went from $35 to $27.50, much of that occurring in 2.5 trading days. And so if you look at a silver price chart, you wiped out the prior major low in December which had halted. It had dropped from 35 down to just above 30, and went back up to 35 by March of this year, and then puked through that low like it was the end of the world. And in a heartbeat, it went from 27.50 up to like 30 and a half, 31, 32, 33, and right now we're trading in the 32s. I suspect this sell-off doesn't have much more time in days and or price, and that we can see when we look at momentum, whether we're looking at real short-term silver gold momentum like day-to-day type momentum action, or looking at some bigger pictures, it looks like it's a setup for another surge. In other words, we're just having another pullback, and I don't think silver is going to have another puke. You don't generally have two of them. In other words, if you had one that washed everything out and immediately slingshotted back up into normalcy, you don't do it again. You've had your cleansing. So any people expecting a duplicate cleansing, I think they're wasting their time. Anyway, that's where I think we are. I think we'll come up out of here pretty shortly, and there are some structures overhead on momentum and even on price that say you get back up 34, 35 on silver again, watch out. You could really blow at that point. Upside. Don't assume you've got to go back to a prior high. That assumption is not proved valid. And there's another assumption that's been kicked into the gutter, okay? I'm tired of hearing it. If the stock market goes down, gold and silver go down. Okay, well, if you look at what's happened over the last couple months, it's been totally opposite to that. Now, there was that one time where silver did puke with the stock market, but then it dusted itself off and said, you know what? I shouldn't have done this. So zoom, you're back up in the 32, 33 zone after being at 27.50. So it was a mistake on the part of those who sold. But gold didn't really flinch that much. And if you go back and look when the S&P made its highs, which would be like in January. In fact, we put out our first sell signal in the first week of January. And 2 weeks later, the market made a new high. S&P did marginally, and that was the top. Go back and look at what happened from gold through March, April, etc. Stock market from January through March, April. Total opposites. And now, what's gold and silver doing over the last week or two? They're pulling back. What's the stock market doing? Rallying. So, in other words, forget that notion going forward that we must move with the stock market. No.
Michael Oliver argues that gold and silver have decoupled from the stock market, and investors expecting lower prices or a metal crash if equities fall are mistaken. He points to recent market behavior showing that gold remained resilient while stocks declined, and even when silver briefly sold off, it quickly rebounded, signaling a mistake by panic sellers. The long-standing belief that precious metals must move in tandem with equities no longer holds, as recent months have shown a clear divergence. According to Oliver, gold has been steadily rising for over a year, only recently entering an acceleration phase. Silver, meanwhile, is approaching key breakout levels and could follow with even more powerful momentum. Oliver also believes the stock market has already peaked, describing the current rally as deceptive and fundamentally broken from a long-term momentum perspective. While he doesn't hold short positions in stocks, it's not out of optimism. It's because he sees far greater returns in being long on gold and silver. He predicts that once equities break down again, the Federal Reserve will respond with aggressive rate cuts and liquidity injections, which will further debase the currency and push precious metals higher. For Oliver, the biggest gains ahead are not in stocks, but in the monetary metals, especially as central banks prepare to intervene in a weakening economy.
To link the correlation between gold and an incident of a stock market sell-off back in October of 2008, for example, or the COVID sell-off in March of 2020, those are isolated, rare events. They're not norms. And so people make the mistake of remembering only those particular minor instances and treat it as a norm. And they should have learned over the last several months it's not the case. Gold will benefit from a stock market top. We've argued that all along. It hasn't waited for the top to go up. Obviously, it's been going up solidly for a year plus out of that prior range. And but when the stock market breaks, that changes the data points. and also will change central bank policy in the Western world. And I think we'll start to see that with the Fed pretty soon. They got numbers today that allows them to twiddle their thumbs some more. Yesterday, they got numbers that weren't too great, GDP. But the unemployment number today was okay, so they can twiddle their thumbs. And I think they enjoy that because they definitely want to, shove it into Trump's lap. So they can say, well, we came to the rescue like a month or two from now when they start cutting rates. They could claim, well, he did it, we're trying to rescue it. But anyway, that aside, they will liquefy events. When the stock market breaks and the data points go, they'll go berserk again. And what does that do? That just helps degrade the value of the money you have by increasing its quantity. And that's what ultimately drives gold over the long term.